Welcome to another episode of Heartland Market Talk on the open range. Gold prices surging today, again to new all-time highs, well over 2,380, as the gold market has many asking the questions, why the surge right now? The Federal Reserve is trying to control the inflation, but are they really doing it? Tomorrow's CPI data has to come in lower. Otherwise, if it's higher, it means the Federal Reserve does not have the reins on top of what is going on. And many think that the Federal Reserve is dragging their feet because they usually work for the party in power. So with President Biden's re-election campaign in trouble, they want to stay with their 3 rate cuts as we get later in the year because people vote based off of their surrounding life. They don't think about what they were thinking of 6 months ago. They think about in the previous month or two, and they want to see these interest rates coming off. Even American Express and Goldman Sachs right now, they're lowering rates on their savings account. Why is that? Are they in the know at the Federal Reserve, no matter what the CPI print is tomorrow, are going to stay with the course to lower rates later this year, which does not slow inflation? This is why gold is likely racing to the upside until we hit some kind of news story that otherwise says the Federal Reserve will strengthen rates, not lower them later in the year. Oil prices softening today. Of course, a possible solution to the Hamas war always is the story we get when we get a soft day like this. Also, the EIA, they were out with their data that says the production of oil is going up here in the U.S., probably up to 13.2 million barrels a day of extra supply, while the economy does not seem to be needing more than what is being provided right now. So it's time now, let's go into Heartland Insights. So taking a look at spot gold here today, here is the stellar run that's been going since last fall, hitting a new high today, 2,880 plus before we retreated just a little bit on the session. Note, we've been discussing this spot gold monthly breakout, how we had 4 years worth of resistance that we went through. And when you see something like this consolidation, you take the size of the consolidation, and that typically tells you initially what we might be running to. Well, we should run here through this high about $400. This implies 2,450 to 2,500 we've been talking about on this show. So far, we've seen 2,380. Now, I wouldn't be surprised if we get a bold pullback in here, and I'll be frank with you. We could pull all the way back to the breakout, depending on CPI data and what the Federal Reserve's, and then take off again later on. This is a monthly chart. So what I just drew here takes up over almost 2 years worth of activity. So we are climbing, but a pullback always is a possibility. On crude oil, making a high last Friday with the peace talks possibly building, and inventory supplies also on Wednesday maybe going to be building as well in our Department of Energy numbers. We're now seeing a correction off of this higher valuation that we went to over $87, even though we do think the prospects of touching $89 is in the cards. As you can see, we always get these little corrective moves, and we might get something going here before we push higher. Typically, crude oil likes to peak in the month of May or June when we get these winter to spring rallies that take place. On the cattle market as of late, we had the H5N1 scare over the last 2 weeks that took the cattle market substantially off of its better levels that we had seen, some $15 to $20 drops, depending on which contracts we look at. But on the June live cattle, very important support that we just hit here just a few days ago to start the week. If we look at a live cattle continuation chart, this purple line, we call this moving average support, and it's a valuation that tries to do trend line, plus it takes into account the wiggles of the market. I want you to note that ever since 2020, we've tagged it twice. Last fall, busted it by a few sessions, and now earlier this week, we touched it almost perfectly like we did here in prior years and have since bounced. I bring this to your attention because it's very important that this value holds and we start recovering this trend line, and that we've overcome the H5N1 scare, as consumer demand has not fallen off, but this has to hold. If we start falling below this 172 mark, then the cattle market is in trouble, especially if it lasts more than a couple days. Then it implies something greater has occurred, and it's not the tight cattle supplies are a problem, it's that demand is a problem. And as we look at demand, hogs took off to the upside over the last 2 weeks, thinking they're going to capture a swift shift in consumer demand. It has not happened. The futures market is about perceptions right now. So if we don't see a shift in demand, the hog trade will likely come off as the cattle trade tries to advance its recent weakness. Now, the wheat trade, This has been an ongoing struggle to ever get rolling. The market peaked back in March of 2022 after the initial invasion of Russia into Ukraine. We've been a long downtrend since then. We're kind of micro-viewing this here. Since December, the trend line has been very well defined. Early this week on crop ratings, we had that the perceptions that the 100-mile winds that occurred down in the southern plains, 50 to 100-mile-an-hour winds, which were much greater than we experienced over the weekend, they thought they were going to see a decline in ratings, so the market pushed higher, advancing towards that trendline resistance, and today and yesterday backed off from it because reality is the USDA did not lower ratings yet. But dryness through the end of April maybe could get ratings to come off. As we get further into next week and the week after, maybe we'll start seeing this trend line broke. And on technical basis, with the index funds being so short of the wheat market, we could see a lift technically on this wheat trade that could put a 50-cent move on or more in quick order when those funds become a bull in the China shop. And finally, cocoa. It did stall out at the $10,000 mark here last week, went into a correction, a typical two-day correction. Turned around just like we talked about last week to you on the TV program. Multiple day corrections, find buying to the upside. And here's cocoa today, right back at its best closes, 10,200. Still not showing a sign of a retreat. And that means the prospect of your favorite chocolates, if they don't shrink the size of the package and keep charging you the same amount, they're going to start raising the prices of chocolate. You think your king size bars are expensive now? You just wait. Cocoa, the cocoa is moving higher still. For today's question of the day, a viewer asks, why are the markets so volatile in the summertime compared to the wintertime? Well, that is a very simple answer. Most of the food is grown in the Northern Hemisphere. Southern Hemisphere, we have Australia, which has a lot of barren ground. And then in South America, we basically have Brazil, Argentina, and Paraguay. And Brazil, a very large country, 2,300 miles from the northern producing areas to the southern producing areas, they have a large Amazon rainforest. Now, when you go to the Northern Hemisphere, you have not only the U.S., Canada, and Mexico, but you have all of Europe, Russia, and China, along with India. Big producers of grain products in the Northern Hemisphere. So when our weather markets get variable and produce shortfalls, that creates these large swings in the marketplaces as forecasts go from dry to hot, back to wet and cool. And that's where these large swings come from in the price versus the wintertime. Brazil and Argentina can make swings, but nothing like the Northern Hemisphere can do with Russia, China, or the U.S. Again, if you have a question, send it to info@heartlandinvest.com. Remember, you can always call us at 701-222-0221 or visit us online at heartlandinvest.com. While you're there, don't forget to check out our Heartland Market Talk podcast and sign up for our daily newsletter. And for producers, remember, we offer crop and LRP insurance as well. Thank you again for watching Heartland Market Talk on the Open Range.